Foreign trade. 7. Introduction. Kautilya'S Arthashastra described in detail the trade and commerce carried on with foreign countries, and the active interest of the Mauryan Empire to promote such trade. Goods were imported from China, Ceylon, and other countries. Interestingly, the trade was not free from levies. Levies known as avartanam were collected on all foreign commodities imported to the country. Levies called varadaya, which was paid by the concerned businessman for the import of foreign goods, was in addition to the ferry fees of all kinds. This helped augment the tax collection. However, the medium of tax payment was either in gold bars or in coins. Kautilya in his treatise elaborated on the extraction of metals from ores, the manufacture of metallic alloys, and the minting of coins. For silver coins he has used the term karshapanas. Coins of foreign origin were also in circulation in the state. Thus, for a long period of 1,000 years or even more, India's foreign trade was of surplus nature. With a continuous inflow of gold in the form of coins or bars used by foreign traders to purchase Indian commodities, India was transformed into Suvarna Bhumi, or golden land. Greek coins with a punch mark were in circulation as the official currency. Later, Roman coins, especially those made of gold and silver, were brought in by traders. Trade with the Roman Empire flourished from 1st century BC. From Rome, India imported chemicals, wines, high-quality pottery, some metal alloys, and gold and silver in the form of coins and bars, and exported silk and their articles, spices, precious stones, jewelry, etc. This trade was generally very favorable for India. Kautilya, apart from being a man of wisdom and perfect strategies, propounded duties, non-tariff, as the ideal way of living for every individual of the society. His principles of foreign trade are even today taught in universities, based as they were on the theory of comparative advantage. His art of diplomacy is well known across India and practiced in the areas of defense, strategy formation, and foreign relations. The land revenue was fixed at 1/6 the share of the produce, and import and export duties were determined on ad valorem basis. Import duties on foreign goods were roughly 20% of their value. Interestingly, India, which had import duties often exceeding 100% till a few years ago, has now reached the level of 20%. Similarly, tolls, road cess, ferry charges, and other levies were all fixed. Kautilya's concept of taxation is more or less akin to the modern system of taxation. His overall emphasis was on equity and justice in taxation. Trade as revenue generator. Trade was mostly carried out by the state, and private trade was allowed in areas other than in which the state had monopoly. The revenues raised through trading went partly to finance the army and to expand territories. Supervision and control over trading. In order to have effective control over trade, monitoring was done through 7 out of 34 departments envisaged. The head of each of the department was called Adhyaksha, or chief controller in the present-day parlance. The 7 departments overseeing and monitoring trade activities were I. State trading, E. Private trading, E. Customs and Octroi, IV. Ports, V. Weights and measures, VI. Shipping and ferries, and VII. Surveyor and timekeeper. There being neither air cargo nor railways at that time, mention is made only of shipping and ferries. In state trading, the sale of goods over which the state exercised monopoly, collection of the transaction tax, VG, and tax on export of crown commodities was the main function. In private trading, the controller ensured orderly marketing and prevented traders from making excessive profits. He was also responsible for consumer protection. Further, sulka, duty, represented customs duty levied on imports and exports. This duty was collected not at the frontier posts, but at the gates of fortified cities, particularly of the capital. Kautilya points out that not only foreign goods, but also domestically produced goods which entered the city from the countryside were subject to sulka. Likewise, the goods produced in the city and sent outside were also subject to duty. Thus, there was no distinction between the octroi and customs duty, perhaps due to the relatively smaller size of the area which constituted the country. Since sulka duty was levied at the gate of entry of the city, there was no need for government control over the sale of goods in the countryside. However, the government exercised control and prohibited sale of goods at the places of production such as mines, fields and gardens. Penalties were prescribed for violation of the ban on sale at places of production, and the penalties were quite stiff. Sale was allowed in designated markets where the private merchants came under the control and purview of the controller of private trade. The chief controller of shipping and ferries was entrusted with a wide range of responsibilities which included, among others, supervising maritime safety and reserve, running shipping services, hiring ships and boats with or without crew, organizing ferries, controlling the movements of foreign merchants, collecting revenue such as road cess, customs duty and ferry charges, and ensuring security by keeping a watch over undesirable persons using the ferries. Imports of goods. Consistent with the policy of providing services to the people, the sale of imported goods was permitted in as many places as possible so that they were readily available to the people in towns and the countryside. In fact, assistance was provided to encourage import of foreign goods required in the country. In other words, there was no restriction on the imports of goods, in case these were required by the people so that they did not feel oppressed for want of goods. Traders were given two incentives. Local merchants who brought in foreign goods by caravans or by water routes enjoyed exemption from taxes, so that they could make a profit. This specifies the basic principle of management, i.e., to encourage entrepreneurship. Those merchants who took the risk of travel to import goods were encouraged through tax exemption. Foreign merchants were not allowed to be sued in money disputes unless they had legal status in the country. Their local partners could, however, be sued. Thus, the liability was always on the citizens to ensure fair trade practices and better goods for the consumers. Thus, the system provided both for an incentive to foreign trade as well as strict procedures and penalties to ensure fairness. The threshold limit of profit was also indicated. Traders were allowed profit margins of 5% on locally produced goods, 10% on imported goods. When there was an excess supply of a commodity, the chief controller of state trading would build up a buffer stock by paying a price higher than the market price. However, when the market price reached its start price, the controller was authorized to change the price and work out a strategy. Further, the price was fixed taking into account the investment, the quantity to be delivered, date, interest rate and other expenses. Exports on government account. Since there was no paper money prevailing then, foreign trade was on barter basis. It was the state trading office which determined the level of expenses to be deducted for arriving at the allowable profit margin. Basically, there were two main types of expenses, one relating to caravans which included custom duties, road cess, escort charges, tax payable at military stations, ferry charges, daily allowances paid to merchants and their assistants, and two, the share payable to the foreign king. In addition, the cost of hiring ships and boats, and provisions for the journey required, would also be included. Arthashastra insisted upon foreign trade resulting in a profit and discouraged trade to areas found to be unprofitable. So the risk and reward system was very much prevalent in the Kautilya'N era. Nevertheless, the terms of trade was not just dependent on economics but also on other various parameters. The traders had to keep in mind the political or strategic advantages in exporting to or importing from a particular country. Echoes of such strategic considerations can be found today in the continued import of palm oil from Malaysia despite self-sufficiency in it thanks to the technology mission. With regard to trade, some precautions were indicated. When goods were transported over land, the chief controller needed to ensure that not more than a quarter of the goods were of high value, presumably to prevent theft of an entire consignment of valuable goods. Various offices such as frontier officers and governors were contacted to ensure safety of goods in transit. Extra precautions had to be taken in case the caravan contained goods of high value. In the event that the caravan could not reach its destination, the goods could be sold wherever it was at the time. When goods were transported by water, seasonal changes in weather had to be considered to avoid damage. Domestic trade. 8. Introduction. After agriculture and manufacturing, trade was considered to be the third most important activity. It was the king's responsibility to promote trade and commerce by setting up trade routes over land and water and to designate markets and towns including ports. It was clear that these trade routes were to be kept free of harassment by courtiers, state officials, thieves and frontier guards, and that these routes were not to be damaged by herds of cattle. In other words, cattle rearing, which was a big part of the agricultural economic area, would in no way interfere with the trade routes. Protection of trade routes. The king had to protect those using trade routes from harassment by courtiers, state officials, thieves and frontier guards. Frontier officers had to make good what was lost. Kautilya felt that just as it was impossible not to taste honey or poison which was on the tip of one's tongue, so also it was impossible for those dealing with government funds not to taste, at least a little bit, of the king's wealth. This is a powerful assertion signifying two facts. First is the realization that trade routes were important for the development of the economy and the safety thus needed to be assured. The second is a warning about corruption in matters relating to trade. Under no circumstances should those who were entrusted with the job of maintaining safety of trade routes be permitted to indulge in corrupt practices which by virtue of holding public office would succeed in diverting the resources from the state to private hands. Even at that time, the king or his advisers were aware of the possibility of the officials and frontier guards indulging in corruption. 2. Typology of domestic trade. The concept of gross margins was practiced in Kautilya's time rather than that of value added. The king prescribed that gross margins of the trader should not be excessive so that the products available to the consumers were at reasonable rates. Unlike today, profit margins were not market determined, perhaps, in keeping with an era in which a benevolent king cared for the welfare of the people. The system of state trading was well established and there were prescriptions on how trading was to be conducted. Kautilya'S Arthashastra meant the science of material gain. It is very clear that its aim was to benefit people. According to Arthashastra, Kautilya belongs to that school of politicians whose policy is to justify the means by the noble end sought to be achieved, which Kautilya as a conqueror had to win at any costs. For Kautilya, the end was more important and ranked higher than the means. Modern economics talks about the concept of value add. Kautilya broadly divides the economy into three sectors: I. State, government, king; E. Private, and E. Service providers such as banks and financial institutions. Kautilya'S Arthashastra was very clear about the role of different sectors, but it was the king who was at the center of decision making. In trade involving the private sector, only the safety of the routes was ensured by the state, and compensation in the case of loss was prescribed. Sale proceeds from mining activity accrued to the state, since it controlled the land. Private trade, however, consisted of selling manufactured products to households. These were supplemented by imports, in case of shortage. Exports were freely encouraged. The trade control system was well defined and articulated. One of the policies laid down was that commodities were to be brought to designated markets where only these were to be sold, and not at the place of production. The officers in charge of the sale of government commodities had to deposit the proceeds in a box with a lid with only one hole so that there was no scope for taking out the same once deposited. At the end of the day, accounts would be given and the money handed over after taking the balance stock. The policy and the procedure laid down showed that Kautilya was fully conscious of the possibility of officials engaging in corrupt practices. 3. Relative merits of different types of economic activity. An ideal Janapada was one which was easily defined and which had a lot of productive land with cultivable fields, mines, timber forests, elephant forests, and pastures. Agriculture was the most important economic activity. Cultivable land is better than mines because mines fill only the treasury while agricultural production fills both treasury and storehouses. The king had to ensure that agriculture was protected from harassment by not levying onerous taxes or fines, and by not making undue demands for free labor. Building forts, defense preparedness, waterworks and reservoirs as the source of crops. Trade routes were also a means of outmaneuvering the enemy because it was through these that the king could send secret agents and bring in weapons and other war material. It was better to have a large production of low-value minerals than a small production of high-value ones. Productive forests should be large, near the borders of the country with a river and yield material of high value. It was better to have a large number of trade routes even if they were not all built to high standards. Kautilya's order of preference for establishing trade routes: land route preferably to the south, a water route on the coast and the inland waterway. Cart tracks and tracks usable by draft animals were preferred over footpaths. As earlier mentioned, trade was the third pillar of economic activity, and the Arthashastra details every aspect of trade. Apart from promoting trade by improving infrastructure, the state was required to keep trade routes free of harassment by courtiers, state officials, thieves and frontier guards. Kautilya appears to mistrust traders, believing them to be thieves with a propensity to form cartels to fix prices and make excessive profits, as also to deal in stolen property. He prescribed heavy fines to discourage such offenses by traders and with a view to protect consumers. Further, the law on dealings among private merchants included selling on agency basis, b. revocation of contracts between traders, c. traders traveling together and pooling the goods, iv. safety in transit. It was also enjoined upon the frontier officers to ensure the safe passage of the merchandise and to make good any loss incurred. Responsibility to recompense loss to traders vested with the village headman, barring, of course, goods that were stolen or sent away. Further, if any property of trader was lost or driven away in an area between villages, the person responsible was the chief superintendent of pastures, CSP. In the regions which did not fall under the control of CSP, the responsibility was that of Hora Rayu. Finally, if the responsibility could not be fixed on any official, the people of the village within whose boundaries the loss had occurred were collectively responsible to the trader. It is thus seen that the importance of the trader was recognized by Kautilya, as also the importance of the rule of law by restoration for any loss caused. At the same time, traders were prevented from oppressing people. This clearly shows that the welfare of the people was uppermost in the mind of the king. Appendix: Chief Controller of Private Trading. Responsibilities: I. To ensure fair trading in new and old articles. E. To allow sale, pledging of old articles only if seller, pledger would provide proof of ownership. E. To inspect the weights and measures used by merchants in order to prevent fraudulent use. B. Contract over merchants. I. To ensure that profit margins of 5% on domestically produced goods, and 10% on imported goods were adhered to. E. To ensure that goods were sold at the prices fixed for them. E. To ensure that merchants did not deal in stolen goods. C. Assistance to merchants. I. To provide appropriate exemptions, if goods held by the merchants were damaged for unforeseen reasons. D. Brokers and middlemen. I. To ensure that merchants did not count the brokerage paid to middlemen as part of the costs in calculating the profit margins. E. To allow brokers to hold stocks of grain and other commodities to the extent they were authorized. E. To confiscate any stock held by brokers in excess of authorized limits, and to deliver these to the Chief Controller of State Trading for sale to the public. E. Orderly marketing. To prevent the collective purchase by merchants of commodities as long as the goods of an earlier joint purchase remained unsold. Government finance. 9. Keyword Arthashastra means science of wealth creation. Kautilya, however, used the word in a much broader context to include many of the activities of a state: economic, political, social, military and others that may affect its wealth. Kautilya's Arthashastra is a masterpiece, particularly in the context of the time when the book was written. He seems to have an encyclopedic and all-encompassing knowledge about different aspects of governing a monarchy, such as administration, revenue, taxation, law, diplomacy, business and trade, coinage, agriculture and land tenure, labor, people and the society, etc. Kautilya emphasized that the state is sustained by the revenue it collects from its subjects. His ultimate objective was not to benefit the king, but to benefit the people. He thought a strong and wealthy monarchy would be in a position to protect the interest of the people against invasion by other kings. Kautilya established the principles of taxation and the sources of revenue and expenditure. In essence, it is one of the earliest recorded guidelines of public finance. He also categorized types of revenue incomes and laid down the systems for audits which are comparable to existing mechanisms. Moreover, Kautilya states that which remains after deducting all the expenditure already incurred and excluding all revenue to be realized is net balance, NIV, which may have been either just realized or brought forward. This concept is akin to the modern theory of fiscal balance and ideas of audit, and Kautilya can be credited for institutionalizing such concepts in the framework of governance and policy. Principles of taxation. Kautilya's discussion of taxation has several underlying principles. The taxing power of the state should be limited, tax should not be felt to be heavy or excessive, tax hikes should be introduced gradually, tax should be levied in the proper place, time and form, and tax level should be equitable and reasonable. Kautilya noted that a ruler should not tax at his pleasure. He took extreme care in avoiding fiscal tyranny and consequent public discontent. According to him, disloyal and indifferent subjects will endeavor to destroy even strong kings. He stressed that subjects should be taxed in such a way that they maintain their ability to bear future burden and, if necessary, a heavier one. Increase in tax should be gradual during times of prosperity. Even today, one of Kautilya's maxims on taxation is very much alive and calls for adherence by the governments all over the world. According to Kautilya, taxation should not be a painful process for the people. There should be leniency and caution while deciding the tax structure. Ideally, governments should collect taxes like a honeybee, which sucks just the right amount of honey from the flower so that both can survive. Taxes should be collected in small and not in large proportions. He did advocate proportionately higher income tax on the rich and higher sales tax on the luxury goods. However, to Kautilya, it was essential that a ruler supply sufficient overhead capital and developmental assistance, or encourage it through tax exemptions. Further, a king should direct expenditure to profitable projects and have in hand sufficient reserve of money, food, clothing, and ammunition to meet the need imposed by calamities, war or other emergencies. Many groups were exempt from tax either due to their inability to pay, handicapped conditions, or the service they were engaged in, priest. The land tax and tax on traders were collected only if there was a profit above the normal level. The schedule of taxes on production and sales was prepared after carefully calculating the cost of production and the normal profits, the length of time needed to sell the product, the level of unsold inventory, the fluctuations of the market, etc. Taxation by the state took into consideration the conditions necessary for ensuring the stability and welfare of the taxpayer. Different kinds of taxes existed, such as direct and indirect taxes, sales and excise taxes, income and value-added taxes. It seems Kautilya's scheme of taxation involved the elements of sacrifice by the taxpayer, direct benefit to the taxpayers, redistribution of income, the state took care of the poor, and tax incentives for desired investments. One of the unique features of his tax policy was to allow for a normal amount of profit for businesses before the tax was collected. Kautilya's tax system seems quite comprehensive, particularly in light of the antiquity of his writing. However, some of his ideas on taxation existed in Indian literature even before Kautilya penned them. Classification of public revenue. Kautilya identified an exhaustive list as the sources of government revenue, and put the actual administration of revenue collection on the department under which that particular activity was covered. The Collector General, i.e., the Chief of Revenue, was to consolidate the revenue from all departments into the central treasury. Thus, an institutional mechanism for revenue collection was set up. The system is very similar to modern systems of revenue collection and management, whereby the actual collection was decentralized while the consolidation and audit was centralized. Sources of revenue mentioned in Arthashastra under the corresponding modern categories can be highlighted as below. Corporate taxes, the corporation or guild of artisans and handicraftsmen, Karusalpagana. Indirect taxes, liquor, slaughter of animals, threads, oils, ghee, sugar, Kesara, the state goldsmith, Sovanika, the warehouse of merchandise, rivers, ferries, boats, and ships, road cess, Vartani, ropes, Raju, and ropes to bind thieves, Kararaju, and taxes on minerals. Land and property tax, town houses and building sites, Vishtuka, pasture grounds, agricultural produce, flower gardens, fruit gardens, vegetable gardens, wet fields. A large part of tax on agriculture was received in kind. Customs duty, sulka, was collected on all imported goods at the city gates, and the work of collecting customs duty was supervised by Sulkadyaksha, viz. Superintendent of Customs. Fees and government service charges, tolls, fines, weights and measures, the town clerk, Nagarika, the superintendent of coinage, Lakshanadyaksha, the superintendent of seals and passports. Income taxes, produce from crown lands, Sita, portion of produce payable to the government, Bagar. Entertainment taxes, prostitutes taxes and gambling charges. Public expenditure. Items of expenditure were classified under 15 heads. This was known as Vyasarira, the body of expenditure. The majority of items involve expenditure on state accounts. Only a few may be regarded as constituting the privy purse of the king. Perhaps the most important public policy ideas in this section come from Kautilya'S analysis of productive and capital expenditure as opposed to non-productive expenditure. In the Arthashastra, a clear distinction is made between revenue invested, i.e., capital expenditure, and current expenditure. For Kautilya, there were two kinds of expenditure, viz., daily expenditure and profitable expenditure. Daily expenditure was the obligation of the state to maintain certain services and functions for the people, i.e., the day-to-day expenditure of running an administration. For Kautilya, the expenditure that earned revenue once in a paksha, a month, or in a year is called profitable expenditure. Kautilya understood that such profitable expenditure, in essence, puts a check on spending from the current account. Investment of capital, vikshepa, is a means to check expenditure, vyayapratyaya. Kautilya realizes the importance of capital expenditure through which the state can earn revenue in the long run. He states, the king will have to suffer in the end if he curtails the amount of expenditure on profitable works. The emphasis on a proper system of audit and the quality of revenue administration is exceptional. In essence, it reflects Kautilya's focus on institution building and management. Kautilya underlined the categories of works that needed to be done by the revenue department: the business of upkeeping the government, samsthanam, the routine work, prakara, the collection of necessaries of life, the collection and audit of all kinds of revenue. These constitute the work in hand. That which has been credited to the treasury, that which has been taken by the king, that which has been spent in connection with the capital city not entered in the register or continued from year before last, the royal command dictated or orally intimated to be entered in the register, all these constitute the work accomplished. Preparation of plans for profitable works, balance of fines due, demand for arrears of revenue kept in abeyance, and examination of accounts, these constitute what is called part of work in hand. The function of a wise collector general, according to Kautilya, was increasing the income and decreasing the expenditure, a maxim that goes well with our current ideas of cutting down on fiscal deficit. Government servants and governance. Kautilya clearly stated that the people's and therefore the state's prosperity depended on the conduct of government servants, yet another example of Kautilya's concern with governance and institutions. Kautilya was also against big government machinery. Dispensing with the service of too many government servants is conducive to financial prosperity of the state. Kautilya identified 40 different methods of embezzlement of public money, and prescribed the harshest punishment for such an offense. Under the above circumstances, embezzlement, the persons concerned, such as the treasurer, niyaka, the prescriber, nibandhaka, the receiver, pratagraka, the payer, dayaka, the person who caused the payment, dapaka, the ministerial servants of the officer, mantri vyavaratyakara, shall each be separately examined. If any one of them tells a lie, he shall receive the same punishment as the chief officer, yukta, who committed the offense. Kautilya also understood the need for transparency during the investigation of public servants and the practice of whistleblowing on corrupt practices. A proclamation in public prakara shall be made to the effect that whoever has suffered at the hands of this offender may make the grievances known to the king. Those who respond to the call shall receive such compensation as is equal to the loss they sustained. Kautilya recommends that public servants, while engaged in work, shall be daily examined, for men are naturally fickle-minded and, like horses at work, exhibit constant change in the temper. Hence the agency and tools which they make use of, the place and time of the work they are engaged in, as well as the precise form of the work, the outlay, and the results, shall always be ascertained. Hence the chief officer of each department, adhikarana, shall thoroughly scrutinize the real amount of the work done, the receipts realized from, and the expenditure incurred in that departmental work, both in detail and in the aggregate. Kautilya admitted that some amount of corruption would always exist and cannot be scrutinized perfectly. It is possible to mark the movements of birds flying high up in the sky, but it is not possible to ascertain the movement of government servants with a hidden purpose. He therefore recommends the strictest punishment, both material and corporal, as a disincentive to cheat. Kautilya had given detailed instructions on check and balance accounting and auditing for the royal treasury of the Great Maurya Empire. However, Kautilya conceded that it is just as difficult to detect an appointed official's dishonesty as it is to detect how much water a swimming fish drinks. Classification of financial frauds. In the Arthashastra, fraud prevention as well as fraud detection has been highlighted. Kautilya had listed several ways of misappropriating public funds by way of fraud against which auditors at the Royal Treasury had to always be on the guard. Some of these frauds relevant in today's corporate environment are a falsification of date with a motive of personal profit, showing a later date than the one on which income was received or showing an earlier date than the one on which expenditure was incurred and using the proceeds in both cases for personal profit for a period. B. Misrepresentation of income received or expense incurred with a motive of personal profit. I. Revenue due on a given date is allowed to be collected at a later date for a consideration. E. Revenue not due till later is collected earlier by force or deceit but credited on due date. E. Revenue paid by one is credited in the name of another for a consideration. IV. Revenue for Treasury realized in the capacity of a collector is misappropriated by an individual by force or deceit. C. Discrepancies arising out of willful fraud in I. Personally supervised work. E. Account heads. E. Labor and overhead charges. IV. Work measurement. B. Totaling. By quantity. VII. Price. VII. Weights and measures. X. Containers of goods. Actual income was calculated under the three major account heads. The current income. B. Transferred income. C. Miscellaneous revenue. The last category had three further subdivisions which mainly included recovery of previously written off debts, etc. Realizable economies made in investment against planned budgets and any differential, value-added, income. In account books, every entry was to be recorded on the date of transaction, duly classified under the different heads on both sides, receipt and debit. Not maintaining a systematic and legible accounting record was a punishable offense as this was deemed a precursor to a fraud. An elaborate check and balance system was in place to ensure the timely submission of accounts and accounting for every transaction in minute detail. In the event of a discrepancy after audit, the official concerned was made to pay a penalty at least equivalent to the discrepancy. With improved telecommunication and electronic fund transfers now available, the possibility of fraud and necessity of disciplined audit cannot be underestimated. If we systematically categorize the various financial frauds that are being unearthed by present-day auditors and investigators across the world, we will probably find that most of them can be roughly placed under one of the aforementioned Kautilyan classifications. //